A shopping mall can generate more profit sitting still than most businesses make working around the clock. But almost none of that profit comes from the stores you're walking through. So who actually gets rich from a mall, and how does the math even work? Meet WealthCat. Today, we're pulling apart the real economics behind owning a shopping mall, piece by piece, dollar by dollar. Forget the stores for a second. A mall isn't a shopping destination to its owner. It's a machine built to collect rent from as many directions as possible. Let's start with the most basic question. What does it even cost to build one? To a shopper, a mall is a building full of stores. To its owner, it's a single asset that happens to have dozens of businesses paying to exist inside it. The owner isn't selling clothes, food, or electronics. The owner is selling square footage and foot traffic. Every store you walk into is, in a sense, a tenant renting space from a landlord, just like an apartment, except the tenant is a business. That single shift in thinking explains almost everything about how malls actually make their money. The mall doesn't need every store to succeed wildly. It just needs enough rent flowing in consistently from enough directions.
Building a large regional mall isn't cheap. Construction costs typically run $200 million to $500 million, depending on size and location. That includes the structure, parking, utilities, and enough space to house 100 or more individual stores. Smaller community shopping centers are far cheaper, sometimes $10 million to $30 million, but they work on the same underlying model. Most of that money isn't paid in cash. It's financed through commercial loans, spreading cost across decades. This means the mall doesn't need to be profitable overnight. It needs to be profitable enough every month to cover the debt. Every big mall has anchor tenants, the large department stores at each end, like the ones you always park near. Here's the twist. Anchors often pay incredibly low rent, sometimes just $2 to $5 per square foot, a fraction of what smaller stores pay. Some anchors don't pay rent at all. They own their own building outright, on land owned separately from the mall. Why would a mall owner accept that? Because anchors pull in the foot traffic that makes every other store valuable. Without a big anchor store, the small boutiques and restaurants around it would struggle to get customers walking past their doors. The anchor isn't the profit center. It's the bait that makes the rest of the mall worth paying premium rent for.
The smaller stores between the anchors, clothing shops, phone stores, food spots, are called inline tenants, and they pay the real money. Inline tenants often pay $30 to $100 or more per square foot, 10 to 20 times what the anchor pays for the same amount of space. But it doesn't stop at a flat rent. Many leases include something called percentage rent. Percentage rent means the store pays a base rent plus a slice of their sales, often 5 to 10%, once they cross a certain sales threshold. In other words, the better the store performs, the more the mall owner earns, without lifting a finger. This is why mall owners obsess over foot traffic. Every extra shopper isn't just good for the stores, it's a direct paycheck for the landlord. Rent alone doesn't cover everything. That's where CAM fees come in, short for Common Area Maintenance. CAM fees can add another $10 to $20 per square foot on top of rent charged to every tenant. These fees cover cleaning, security, lighting, landscaping, and repairs to the shared hallways and common spaces. In plain terms, the tenants collectively pay to keep the mall looking nice, not just the owner. This is one of the quiet advantages of mall ownership. Many of the day-to-day operating costs get passed straight through to tenants.
That massive parking lot outside every mall isn't just empty space. It's one of the most expensive parts of the entire property. Building a single parking space can cost $3,000 to $5,000, and a large mall might need thousands of them. Parking doesn't generate direct rent, but without it, no anchor store would ever agree to move in. It's a cost the owner absorbs because the entire business model collapses without somewhere for shoppers to park. Now let's put it together. Every dollar of rent, percentage rent, and CAM fees adds up to the mall's total revenue. Subtract the operating expenses, maintenance, security, insurance, property management, and you get something called net operating income, or NOI. NOI is the number that actually matters. It's the mall's real profit before financing costs come into play. A large regional mall might generate $15 million to $30 million a year in NOI, depending on its size and tenant mix. Every decision the owner makes, which stores to lease, how much CAM to charge, how many anchors to keep, exists to grow this one number. Here's where it gets interesting. NOI doesn't just measure profit, it determines what the entire mall is worth. Commercial real estate is valued using something called a cap rate, a percentage that reflects how risky the investment is seen to be. A healthy, well-located mall might trade at a 6 to 8% cap rate. A struggling mall in decline can trade at 10 to 12% or higher. The formula is simple. Value equals NOI divided by the cap rate. A mall generating $20 million in NOI at a 7% cap rate is roughly $285 million. That same mall, if it starts losing tenants and its risk goes up to a 10% cap rate, could suddenly be worth only $200 million, even if nothing about the building itself changed.
Very few malls are owned free and clear. Most are financed with commercial mortgages covering 50 to 70% of the property's value. That means a $250 million mall might carry $150 million or more in debt, with the owner's actual cash investment being far smaller. This is the same leverage principle used in residential real estate, just with far bigger numbers, and far bigger risk if rent income drops. If NOI falls below what's needed to cover loan payments, the mall can be at risk of default, no matter how impressive the building looks. The mall isn't just a building. It's a leveraged bet that tenants will keep paying year after year. There's a number that quietly determines whether a store can survive inside a mall, the occupancy cost ratio. It's the tenant's total rent and CAM fees divided by their total sales, showing what percentage of their revenue goes straight to the landlord. A healthy occupancy cost ratio is usually 10 to 15% of sales. Anything much higher, and the store is essentially working to pay rent. This is why mall owners watch tenant sales closely. A struggling tenant with a high occupancy cost ratio is a warning sign long before they close. When too many tenants cross that danger line at once, the mall itself starts showing cracks.
Now here's the part nobody in the mall business likes to talk about. Online shopping broke this model for hundreds of malls. As shoppers moved online, foot traffic dropped, and with it, the sales that percentage rent and occupancy cost ratios depend on. Anchor department stores, once the mall's biggest strength, became its biggest weakness. Several chains filed for bankruptcy and closed hundreds of locations. When an anchor leaves, it doesn't just remove one tenant, it removes the foot traffic that every smaller store around it depended on. This is how a mall spirals from thriving to what's now called a dead mall. Vacant storefronts, falling NOI, and a cap rate that keeps climbing. It's a brutal reminder, even a business built on collecting rent isn't immune to changing consumer behavior. Some mall owners saw the shift coming and adapted, turning empty department stores into something else entirely. Old anchor spaces have been converted into apartments, medical offices, gyms, warehouses, and even indoor entertainment venues. This is called mixed-use redevelopment, replacing a struggling retail model with tenants that don't depend on foot traffic to survive. A dying mall converted into apartments and offices can sometimes generate more stable income than it ever did as pure retail. This isn't a guaranteed fix. Redevelopment costs tens of millions of dollars and doesn't always succeed. But it shows that the real asset was never a shopping mall. It was always the land in the building. Retail was just one way to use it. Let's put real numbers on a single simplified example. We'll call it Sunset Mall. Built for $250 million, financed with $150 million in debt and $100 million in owner equity. In its strong years, Sunset Mall generates $20 million in NOI annually from anchor rent, inline rent, percentage rent, and CAM fees combined. At a 7% cap rate, that puts the mall's value around $285 million, a $35 million gain on paper on top of the yearly income. Now imagine an anchor store closes, foot traffic drops 20%, inline tenants start missing their percentage rent thresholds, NOI falls to $14 million, and the cap rate rises to 10% as buyers see it as riskier. Suddenly, the same mall is worth just $140 million, nearly half its former value, without a single wall being torn down. This is the part most people never see. A mall's value isn't fixed. It moves with two things: how much rent flows in and how risky that rent looks to investors. Raise NOI by just a few $1,000,000 a year, and the mall's total value can jump by tens of millions, long before any extra cash even reaches the owner's pocket. Lose a single anchor, and that same math runs in reverse, sometimes wiping out more value in a year than a decade of profits ever built. This is why mall owners obsess over lease renewals, tenant sales, and empty storefronts. Every one of those numbers quietly moves a 9-figure valuation. Owning a mall was never really about retail. It was always about controlling the flow of rent and betting correctly on where that flow was heading. So who actually gets rich from a shopping mall? Not the stores fighting for foot traffic, and often not even the anchors, who barely pay rent at all. It's whoever owns the land, the lease structure, and the debt, collecting from every direction, whether the economy is booming or shrinking. That's the real lesson hiding behind the food court and the parking lot. The biggest profits usually sit one layer above the business you can actually see. Malls that adapted,
rethinking who pays them and for what, survived the disruption. Malls that didn't became cautionary tales. The building never changes. The economics underneath it always do. If this made you look at shopping malls completely differently, hit subscribe. WealthCat breaks down a new hidden business model every week. Comment below, would you rather own the mall or own a store inside it? I'll read every answer. See you in the next one.